Happy Tuesday, February 18th. It is your Mortgage Insider update for this week, coming off the President's Day holiday. We have a little bit of a bounce higher in rates after recovering actually from being quite a bit higher late last week or mid last week. We had the Consumer Price Index came out a little hotter than had been anticipated, followed by the Producer Price Index, which came in not quite as hot. So a little bit of bounce around in rates that ultimately have settled back to where we started about a week earlier. Let's take a look at those charts. As we start off with the charts today, the 10-year Treasury up back above 4.5%, 4 basis points. We'll take a look at this hitting kind of a level of resistance that could potentially hold us here until the Fed minutes come out. Federal Reserve meeting back in January. They have the minutes from the meeting post a couple weeks after, and that's where a lot of the discussions that were had during the decision to hold on cutting or changing interest rates for the first time in 3 meetings took place. Also see the mortgage-backed security prices. These prices work the inverse in the rate, so as the price drops, the interest rate, like the 10-year, is going a little bit higher. And we can see over the last week, when we got the Consumer Price Index last week, we saw the bounce up in rates and then just kind of a rejection and a pullback the next day after the Producer Price Index, ultimately settling back to the same level. This is the 50-day average that we've been kind of dancing around since the early part of February, as we've kind of broached slowly a little bit or lower as far as rates. Tried to go even lower, bounce back up, seem to be settling in this range until we can get some more establishment of the pace of inflation specifically and kind of the read on the economy only about 25 days into the Trump administration. Those potential tariffs, potential inflationary risks starting to settle in, and the market's waiting to see. We'd like to show a quick chart on the mortgage-backed security prices. As I talked about, those work in the inverse. So similar to the chart on the 10-year Treasury, we see only the reverse. The price fell pretty substantially back on the 12th, the day that the Consumer Price Index came out, only to be followed up with kind of a bounce back from Producer Price Index and kind of a settling in a range. This being the 50-day average here, 200-day average. Haven't really been able to get any higher or improve rates above the 200-day average. So for now, we'll just have to kind of settle into this area and see where that leaves us. It does leave 30-year mortgages sitting still under 7% at about 6.8% currently. So we'll keep an eye on the news in the coming weeks as we get into the end of February. We'll start to run into the PCE once again, and then at the first of next month, the unemployment reports. This could start to get interesting with unemployment, especially in the government jobs that appear to have been evaporated. A lot of people offered to take buyouts. A lot of that unemployment or reemployment, those people will go and look for different opportunities, whether in the government or in private sector. Those could start to really weigh in on the unemployment rates over the coming weeks, coming months. So we'll keep an eye on that as we also battle the fear of inflation, the fear of tariffs. That is really holding rates in that 4.5% area on the 10-year and keeping mortgages just right above that, obviously, at about 6.8. Hopefully we can get down to this mid-6s, but it could just as easily go back over 7 with the way things are going right now. So have a great week, and we'll keep an eye out for you. Take care.